We are going to go ahead and get started. My name is Beth. I'm the adult programming librarian here at the Mid-Continent Public Libraries. This is managing student loan debt. And we're here tonight with a hybrid program. So we have people here in the room with us at our Lee Summit branch, and we have some friends joining us online as well. So for those of you that are online, I have dropped a link to tonight's survey in the chat. For those of you here in the room, you have our yellow surveys to fill out. So we hope you'll take a moment at the end of the program and let us know how we did. For those of you here in the room, I'm going to ask that you wait to be called on with questions because we are going to be then repeating them so that the people online can hear. For those of you online, I'm going to ask that you type all questions in the chat rather than unmuting yourself so that we can read them and the people here in the room can hear your questions as well. With that, I would like to turn the program over to Jason Anderson, who is our presenter this evening, and I will let him introduce himself.
Great. Thank you so much. And I'm gonna try to stay behind the podium here. I believe the folks on Zoom are able to see my face and a little thumbnail. So I want to make sure that kind of continues throughout the night. But yeah, I'm Jason Anderson. Why am I here? That's probably the main question. So I am, my full-time job is I'm a professor of finance at the University of Kansas. But really more so than just the academic credentials. And what I do, by the way, as a professor of finance is I teach future financial advisors. And so I'm teaching folks that if you work with a money advisor, they maybe have been trained by me. So that's one qualification I bring to the table. The second is that actually in 2024, I sold a business in college and student loan planning. So I ran a college and student loan planning business for about 4 years. It was a successful business obviously, and then sold it. Let me see if I can actually get this thing hooked up. Sold it. So I have worked with clients in a consulting capacity around a lot of these topics. I'm gonna get it one of these days, I promise. Got to be smarter than the microphone, I guess. There we go. Yeah, so did run a consulting business. And then before that, I actually built, if you've ever done banking or credit unioning with Community America Credit Union, I helped them build their college and student loan planning program as well. So that's really why I'm here talking about student loan debt. I don't have a private space in industry anymore, so I do have some folks. I've done this presentation a few times for Mid-Continent, and folks are like, hey, can you help me with my specific situation? I'm like, well, I don't really run a business in this place anymore, but I'm more than happy to refer you to somebody else and some of the people in the space if you really want some additional help after all of this. So disclaimer, let's go ahead and get into some of the content here. And then I'm sure some of you all will have some specific questions, and feel free to put those in the chat if that's of interest to you. And this stuff changes all the time. So literally about 10 minutes before I started this presentation, I changed some of the material. So the first is a disclaimer. I am here, good? All right, perfect. I am here in a capacity of being a finance faculty member, but KU hasn't approved any of this material. I'm kind of doing it on my own. So just keep that in mind as we go along. Okay, perfect. So before I even get into the content though, both online and here, I'm curious as to why you're here. There's a million different ways we could go in terms of student loans. Maybe some of you all are thinking about taking out student loans on behalf of somebody else. Maybe you're thinking about going to grad school. Maybe you currently have debt and you're looking to manage it. So what are those questions that you all have? And I can tailor some of my content towards that. Online or here. Yeah, go ahead, please.
Our son took out a student loan.
Okay. Okay.
He do the online classes very well, and he didn't do well, and so he kind of stopped doing
Okay.
the program.
Yep.
But he still has this debt.
Okay.
Doesn't have a job yet.
Mm-hmm.
So we're here looking for
To see what options. Yeah, definitely. So the question here for those of you that were online, or the statement, I guess it wasn't a question, is that someone took out debt in their lives, in their family circle, still has that debt and looking for the options as to how to pay that off. So we're certainly going to talk about that. What else? Yeah, please. Okay. Yep.
But I did the whole public service loan forgiveness,
Mhm.
and I think I'm almost done, but I'm so confused because they've done it to me like 3 or 4 times. And
Yep.
keep loan companies on me.
Yep.
All of a sudden, my stuff disappears. I have no history of a lot of things. I call them and they claim they can't, I signed up for paper statements only, and then one company said, oh, no, we had you for online, and all my payments are gone, some of my payments are gone on history.
Yep.
So I really think some of my payments are missing, but it really did take my payments. And supposedly I only have 3 more years of government.
Yep.
So it could be paid. Whatever I have left, it's gonna be waived in 10 years, but I had a friend that she said they denied her, even though she had government 10 years.
Yep.
I'm at this point where I don't know who to trust.
Yeah, sure. Yeah, so we'll talk about public service loan forgiveness. That was the statement here is someone's going towards public service loan forgiveness, wondering, especially after a bunch of switches to different servicers, as to what that situation looks like. So we're going to talk about PSLF tonight. Yeah, excellent.
And
Yeah, online.
that we've got somebody online who says, I'm 3 months away from PSLF 120, but on the save plan and hoping to do buyback.
Yeah, absolutely. So we'll talk about the buyback program, and that scenario in particular sounds like a perfect option for buyback. And we'll talk about what the buyback program is and how you can apply for it. Yeah, great question.
Also got currently have debt and looking to manage it.
Mm-hmm.
Forgiveness options for teachers and how much income repayment plan will change.
Yep.
Someone working on a master's with student loans that's looking to be more informed.
Okay.
Someone else is asking, or they're looking for companies or programs out there that don't require a cosigner for a student. And someone asking about whether they should pause paying for undergraduate loans while working on a master's.
Yeah. Okay. Yeah, good. We're going to cover the majority of that. On the cosigner piece, the majority of this presentation is about specifically options when it comes to federal student loans. When it comes to private student loans, as that question kind of makes real, it's really the Wild West. And it very much mirrors a lot of what private credit in any area of our life looks like. So whether you have a mortgage, whether you have a car payment, whatever that looks like. So it's primarily based on your income and your credit history. Well, if you think about a teenage student or an 18-year-old student that's coming up, they probably don't have any credit. They probably don't have much of an income history. And so from a banking perspective, that person is not someone that banks want to lend to. And so what happens is you either get a federal student loan, which is what, again, the majority of what we're talking about here. And part of kind of the government subsidy in offering these loans is that they're offering it to students that in the private space wouldn't be able to get loans on their own. And the government's actually offering it in the student's name alone. Whereas if you go out to a bank, Bank of America or a regional bank or a credit union, and they have a student loan, I know Community America Credit Union has a student loan now, they're likely going to have a cosigner because again, that student doesn't have income or credit history. And so I know of, none that I can think of that won't, that will essentially give it to the student alone and not require a cosigner when they're in a situation where they're not credit worthy. Which is, again, not like a negative thing, not credit worthy in that they had credit and wasted it. It's that they don't have any credit history at this point in their lives. And so that can be a real challenge. Again, that question is highlighting that, but I don't have any like golden or silver bullets on that one. Okay. Good. So we got a lot of things to talk about. We're going to cover the majority of those things. We'll have time for questions at the end as well. And you'll have my contact information at the end of this presentation. So a big piece of the challenge with student loans is that higher ed is getting more expensive. So when I first started in college and student loan planning, this number was in the 200s, maybe 300s, but now we're in like over we're almost $500 or $600. Still cutting it off?
Well, it jumped back, so.
Okay. You may want to try just sharing the actual PowerPoint instead of the screen.
Well, I have to share it to both, to both the screen and Zoom.
Okay.
I think you click here.
Okay. Okay. Sounds good. I can do that. So this number is getting higher and higher. Now, you may have some questions, and we'll talk briefly about it at the end. And this is brand new, is the one big beautiful bill that was passed actually puts limits on student loans going forward. It's also going to change your payment plan options going forward. Now, that's not going to be an immediate change. It phases out over time, but there's going to be some pretty significant changes. And a big push behind that bill in particular is because student loans are getting out of hand. So really, when I did consulting, I'd work with Parent Plus loan holders. It wasn't uncommon for me to work with Parent Plus loan holders that had 250,000 in debt that they had taken out on behalf of their kids. So a big piece of this new tax bill that came out is to try to limit those situations so you can't take out that much debt. Now, a lot of it's just based on the fact, and if you look at the color coding here, it's really just based on the fact that higher costs of living on the coast in particular, but specifically it's more looking at graduate and professional debt. And so when I talk about professional debt, I'm talking about doctors, lawyers, individuals that go and get a professional degree that's really expensive. And so again, when I worked in my consulting practice, a lot of times I was working with doctors that could have 300,000 in debt, 350,000 in debt coming out being a doctor. Now they had the income to service that debt, but again, pretty scary numbers. And whenever you see some of those news articles or anything online that talks about someone with hundreds of thousands in debt, it's likely due to that professional or the Parent Plus loan holder status. So again, why is there so much? And I can pick a little bit on K-State, not because I work at KU, but I have my PhDs from K-State. And so why is there so much debt? Well, if we think about what it costs to live on campus, and again, K-State, if you're in Kansas, which I mean, I know you all are sitting in Missouri, but I live in Kansas. If you're going to a state school, it should be an affordable option. Like that's why state schools exist, Mizzou, KU, K-State. And so we would expect it to be affordable, but what we see instead is that living on campus, full cost for K-State nowadays is about $30,000, which is pretty incredible when you think about it. If we do a 5% cost inflation over time, and just for 4 years, which the average graduation rate is not 4 years, by the way, we hope it to be, but for those that go beyond this, it can get even scarier. That's a total cost of $131,000. It's actually a little bit over that. And so again, the reason why we have a lot of student loan debt, why we have lots of issues, why these are well-attended workshops, is because of this unaffordability problem. Now we're gonna, yeah, please.
That including tuition.
Yeah, so that's including, the question is what does that number include? That figure includes the full cost of attendance. And that's actually something that's used in financial aid to award your debt that you're given, or financial aid like scholarships and grants, things like that. But it would be tuition, room and board, it'd be personal expenses, transportation expenses. Some of those are direct and some of those are indirect. Like with transportation expenses, you're not ever gonna pay that to the school, that's an estimate, but you can take out debt up to some of those maximums. And so, yeah, that's what we're looking at, and that's why that's such a high number. So you may not pay 130,000, but that's what they're estimating your cost would be. Good question. So we're gonna primarily talk about federal student loan holders, which 61% of student loan debt today is federal student debt, which that means that it came from the government, not from a financial institution or credit union. Now, sometimes, at least historically, the federal government used banks to lend this money out. And so it may seem like that you're captive to a financial institution, but this is money that actually came from the government. So the majority of this debt, which is now 1.7 trillion, by the way, to give perspective, all credit card debt in the United States, at least a few years ago when I looked at it, about $1 trillion. So to give perspective, this is a massive bubble in our economy of debt that's out there, even more so exceeding credit card debt. So it's kind of scary in that regard. Now, the average debt amount is maybe lower than you would expect, given some of those, news articles that you read about student loan debt with people with six figures. It's only about $37,000. And the reason for that is because at the undergraduate level, you're actually capped in the amount that you can take out. And from what I've read with the new tax bill, the One Big Beautiful Bill, it's still the same caps. Now, the challenge with those caps are, and we're going to look at them right here. I know this is kind of a busy slide, but if you're an undergraduate student and you're taking out debt in your own name, not a Parent Plus loan or something like that, you're able to take out $5,500 your first year, $6,500 your second year, $7,500 for the third year and subsequent years. So if you're doing the math on that, that's $27,000, and then it's fully capped at $33,000. Well, what's the problem here, right? If you remember what K-State actually costs, that's not enough money to go to school, especially if you're living on campus. And so there are caps here. They will continue to be caps. And now with the new One Big Beautiful Bill, there's now caps on grad school and professional school. Because it used to be that for grad school and parents, that really the only limit that you had in taking out debt was the full cost of attendance, that really high number. And so again, parents could take out debt on behalf of their kids with a Parent Plus loan, and it could be $200,000, it could be $250,000, whatever that looks like. If you had 5 kids, it could be a ton of money. And so that was a challenge. Grad school, again, only capped by the cost of attendance. Now, One Big Beautiful Bill actually puts caps on that, not only yearly caps in what you can take out, but lifetime caps in what you can take out per kid or for yourself. And so you can't take out $300,000 anymore with the new caps, but you could, and things would get pretty scary. So again, I didn't update this. It said new legislation in Congress might drastically cut the aid available. It has done that because that bill has now passed. And so for those that are taking it out in the future, it didn't sound like anybody on this call was doing that, but they will be capped in what they can take out beyond what they've historically been taken out, capped at taking out. Now, if you take out debt today, and the reason why I show this slide is, again, if anybody's here thinking about taking debt in the future for grad school or what have you, they'll get an understanding of what that looks like. But also because I hear a lot of people talk about refinancing, okay? So if you have current debt, especially federal student loan debt, you want to be hesitant to refinance it with like a Wells Fargo, Bank of America, whatever that looks like, SoFi. The reason why is because you lose all the protections that we're going to talk about and kind of the cool programs that we're going to talk about, public service loan forgiveness, et cetera. Those are only for federal student loans. So if you take your federal student loans and you give them to a bank, they pay off those, they give you new debt, even if you're saving on an interest rate, you're going to lose out on those programs because none of the programs we're going to talk about are for private student loans, okay? So if you got your loans from like a Sallie Mae and they're not federal student loans, basically nothing that we're going to talk about today is going to be applicable to you. The other thing is that you may be able to beat some of this, but market rates today, what's being offered in student loans today, for undergraduate students, it's about 6.4% interest. It's about 1% origination fee, so they charge a fee in order to put these out there. For direct unsubsidized loans and direct plus loans, these are more for graduate and professional students or Parent Plus loans. You're looking about 8 to 9% for those. And so again, if you can go out and you can get a 5%, that's great. Like you're beating market interest rates. But if you go out and quote refinancing and they say, hey, it's going to be 8%, like you're basically in the ballpark, right? Which seems high, and it is historically higher than what we've seen like through COVID and historically, but that's what we're looking at. So this is current rates. If you take it out, those are the rates that you would be looking at. Any questions at this point? Anything online that's popped up? Okay, so we'll talk. The question was, and can they hear you when you're speaking? Okay, good. All right, so they can hear. Yeah, we'll talk about both those things. Okay, so now I'm going to talk about what repayment of federal student loans looks like today. Now, again, this is going to change because the One Big Beautiful Bill going into the future is going to phase out these plans, and it's basically going to simplify the system to 2 plans, okay? Those new 2 plans are going to be one standard plan and one income-driven based plan, okay? which is nice from the perspective that like right now it's a little bit crazy, okay? So I do like that they're simplifying things, but we do have to realize what things are now because it's not going to change like in the next couple weeks. These new plans are going to be phased out over time. So there's two types of repayment plans when it comes to federal student loans. The first are the standard type plans. And the reason why I call them standard, or why the Department of Education calls them standard, is because these function like loans in the rest of the world, okay? Student loans don't always function like loans in the rest of the world. The way normal loans work is I take out an amount of money, like I'm renovating my home, I take out $20,000. The bank says, hey, you're gonna pay this $20,000 over 10 years, and then they give me a payment such that if I make that payment over 10 years, that payment is gonna pay me down to zero. Everybody with me? Like this is actually called amortization. And so it's based on my balance and paying it off over time to zero. So that's what a standard plan does. The normal standard plan is a 10-year plan that basically it calculates your payment to pay it off in 10 years. That's what it is. And if you don't do anything, once you get your federal student loans, you graduate, you start paying on them, or in the scenario that we talked about earlier where maybe you didn't graduate, but it's time to start paying, if you don't select something else, you will get put in the standard plan, which is paying it off in 10 years. The majority of people, because most humans don't like to proactively make decisions or change things, go into the default plan. We know statistically that most people are just going into the standard plan. So that'll pay it off in 10 years. There are two kind of modifications to that plan, which are the graduated and the extended plan. So the graduated plan is basically where you pay less at the beginning and more as the loan ages, with the idea that you're going to hopefully get promoted and get better jobs. Extended is where you're taking that 10-year term and you're actually extending it out over a greater period of time. But still, those are both in a situation where maybe your payments are going to change over time, or you're going to pay it over a longer amount of time, but you still pay to zero, right? And so standard plans function like normal loans. But there are a lot of people out there that can't afford their payments. Like maybe you took out $60,000 in debt and you can't get a job, right? So you're in a situation where you can't meet the standard plan. Well, over time we realized, hey, we don't want these people to default. We want them to do what they can. And so in those situations, we have created many over time, what we call income-driven repayment plans. And so anytime you see IDR plan, and the Department of Education will use that terminology, they mean income-driven repayment plan. Your payment is no longer based on paying it to zero. Your payment is now based on what you can afford to pay based on your income, okay? Now the scary thing about this can be that if your income is really low, you may not even be paying enough to meet your interest, let alone your principal on your payments. In other words, you're not making any progress on paying it down. So I've worked with folks that took $200,000 to become a lawyer and they're making $50 payments a month or whatever it is. Well, their balance is growing. It's not going down. And so that's, again, another time when you hear these scary stories on the news where someone ends up with $500,000 or $1 million in student loan debt. It's probably because they're in an income-driven repayment plan and it's not even touching their principal. And so it grows along with interest. So what these do is, depending on the plan that you're in, it's going to be about 10 to 20% of your income that you're paying every month. And then, as you might imagine, every year you have to go back and you have to recertify, this is my income, and they're going to recalculate your payment based on what your income is for that year. That's going to be your payment. Now, that may be a little foreign to some of you all. Maybe you've never recertified before. Because what's been interesting is since COVID and we had all these forbearances and people weren't having to make payments, and then we had all these changes and court injunctions and loan forgiveness opportunities that were eventually taken out by the courts. What's happened is, like, some people have been in an income-driven repayment plan, but have never recertified. In other words, they still have your income from like 5 years ago. That's what you're making payments based on. But in kind of a non-weird world, okay? And when things normalize after this one big beautiful bill stuff kind of, normalizes out, I guess, you will have to every year recertify your income. So that's still a thing. It just hasn't been a thing because of all the craziness of the last about 5 years. So what do we have now? Now these plans have changed over time, but now we really only have three, okay? So we have income-based repayment, We have pay as you earn, and we have income contingent repayment. And you might be asking yourself, hey, what about the SAVE plan? Well, the SAVE plan's still there, okay? And some of you all might be in the SAVE plan, but the SAVE plan was taken out by a court case. And so you might still be in that, but it's kind of a dead on arrival plan. And so you're in forbearance because you can't make any payments on it because they're taking that away based on a court case. And so it's no longer available, although you might still technically be in SAVE. But what that means is, hey, what's next for you? And many of you all have come to this workshop saying, hey, I'm in SAVE plan, now what do? I'm not making progress towards public service loan forgiveness, or I'm not making payments and I want to. So we'll talk about what you can do now. So these are the plans that still exist. And then again, one big bill has changed a lot of that. So what's going to happen with the one, and again, I haven't updated the slides for this because it's so fresh. The one big beautiful bill is essentially going to offer two plans. So one is the standard plan. This standard plan is going to be a little bit different than the one we just talked about. It's going to be based on your balance, and it's going to be anywhere from 10 to 25 years. And so still standard plan, meaning that you're going to pay it off to zero, but that's going to be the only one. You're not going to have any other options. There's one standard plan. It's going to be a little bit different than what we talked about here. The second thing is we're going to have what's called the repayment assistance plan, the RAP, or I don't know if they're going to call it RAP. I'm not sure what the terminology is at this point, but it is going to be an income-based repayment plan. It's going to have monthly payment caps, and it is going to have what we call long-term loan forgiveness, and we'll talk about that on the next slide, but it's going to be a lot longer than what we've seen previously. It's going to be 30 years, and so not ideal, but it still has a trap door at the end. And then again, there's going to be some caps on what you can take out. But this will eventually be phased out to those just two plans. One plan in this category, IDR plans, one plan in the standard plan. But from what I'm reading, it looks like the SAVE plan, the other plans won't be phased out until I believe July 1st, 2028. So again, this isn't going to happen like tomorrow. It's going to phase out over time so that we can move to something else. So what we're going to talk about in this slide deck is what's happening today, because again, we're going to eventually all be moved to those new plans when they implement them, but it's not going to happen tomorrow. So what do we do now? Well, the first thing that I would say is if you're wondering about your situation, like what plan is best for me, you might want to check out the studentaid.gov/loan simulator. The Department of Education does provide a loan simulator that you can log in with your credentials, and it will give you projections as to whether you're going to pay it off or whether you're going for loan forgiveness as to what the best plan is for you. The caveat that I would say here is that it's updating with all these changes, okay? So it may not be as accurate as some of the legal court cases which are happening or the new bills that are being passed in the last couple of weeks. And so make sure it's up to date. And some of the results might be a bit funky because it hasn't been updated based on what's happening as of this current moment. Okay, so other people are saying, hey, what about loan forgiveness opportunities? And again, this is maybe one of the reasons why you don't want to refinance and get rid of your federal student loans, because federal student loans come with benefits. And specifically, one of the biggest benefits is the opportunity to get your loans forgiven. So the big program out there is Public Service Loan Forgiveness, otherwise known as PSLF. This is if you work for a nonprofit organization, government, whether it be local, state, federal, or tribal, and military, that you do have potentially the option to get your loans forgiven if you work for that type of employer. But there are some qualifications, okay? So one of the qualifications is that you have to be full-time, and that's typically 30 hours or more, and you can actually put that together across multiple employers, but you have to be full-time working for one of these qualifying employers that we just talked about. You have to be in a qualifying repayment plan. In a qualifying repayment plan for public service loan forgiveness, and I'm not sure what it's going to be with the One Big Beautiful Bill plans, it may be both of them, but for now, you have to be in an income-driven repayment plan. So if you're not in an income-driven repayment plan, you're not making qualifying payments. So that's one of the things that people messed up on. There's some current programs that can help kind of fix that. If you're in a situation where you weren't in a qualifying plan, potentially, but you do have to be in an income-driven repayment plan. And then you have to make 120 qualifying payments. So many of you all have heard, hey, public service loan forgiveness is a 10-year forgiveness program, and you would be correct, right? 120 qualifying payments divided by 12 months, that's 10 years. But the reason why I say 120 qualifying payments is because these don't have to be sequential. So I do get some people that get confused and they're saying, hey, I worked for the American Cross for 3 years, then I became a stay-at-home mom for 5, then I worked for another 3. Does that mean I restarted with just 3 years? Do I just have 3 years towards PSLF now? The answer is no, you have 6, okay? So just know it doesn't have to be sequential service. It's 120 qualifying payments. So that's what that looks like. It's a 10-year program, so to speak, but you have to be in the qualifying repayment plan. You have to be working full-time for a qualifying employer, and that's what that program looks like. Now, many of you all have come to this workshop because you're saying, hey, I'm not making qualifying payments right now. I'm in the SAVE plan, and they're not letting me make payments. Well, when you don't make a payment, it's not qualifying most times. And again, I'm not trying to confuse or convolute the situation, but you should know, everybody remember COVID, where you didn't have to make payments? Well, guess what? During COVID forbearance, which lasted like 2, maybe 2+ years, if you didn't make payments during that time in forbearance, those non-payments still count for public service loan forgiveness, believe it or not. So one of the really, really cool things about that forgiveness period, or that forbearance period, I guess I should say. Right now, though, if you're in SAVE forbearance, those non-payments do not qualify for PSLF, okay? Now that may change in the future. PSLF is constantly changing. We've had waiver programs, we've had all sorts of stuff. So maybe a future administration that's more amenable to student loan debt might say, hey, we're gonna say that those were qualifying, kind of retroactively, but right now they're not. And so for those of you that are going for PSLF, and you're in the SAVE forbearance, that's a problem for you because you're not making payments, you're not allowed to make payments, and you're not getting any qualifying credit, okay? Okay, then there's teacher loan forgiveness. One of the main things about this, because you might be saying in your head, hey, well, a teacher is probably a state employee or a nonprofit employee, and you'd be correct. So you're like, do they go for PSLF or do they go for teacher loan forgiveness? Well, there's differences between this program. Teacher loan forgiveness is a lower forgiveness amount, but it takes less time to get there, okay? 5 years. It's also, you have to be in a low-income school district. And so PSLF, you don't have that qualification. You don't have to be in a low-income school district. So if you're in maybe like a Blue Valley in Kansas, where I come from, that's not a low-income school district. So you wouldn't be allowed to do teacher loan forgiveness. So there are some people that pick one or the other depending on what their situation is, but that's another option for teachers. Then there's long-term loan forgiveness, IDR forgiveness. So I'd mentioned with One Big Beautiful Bill, there's now 30-year loan forgiveness if you're in that IDR plan. Everybody with me? They're like, what is that? Well, what it is that all the income-driven repayment plans, when they were created, had this kind of trap door at the end of the tunnel, okay? And the end of the tunnel was essentially that if you made payments for whatever that term was, and some it was 20 years, some it was 25 years, with SAVE plan, it could be as quick as 10 years. But if you paid to the end of whatever that term was and you still had a balance, it would actually be forgiven. And we called this long-term loan forgiveness. And again, the idea was that, hey, if you pay on an income-driven repayment plan for 20 years, like you're struggling if you still have a balance, okay? And so the government would actually forgive it. And there were tax consequences to this, like it would actually be added to your income the year that it was forgiven, whereas public service loan forgiveness is tax-free, which is one of the cool things about it. But long-term loan forgiveness did exist. It had some problems, but it existed. So long-term loan forgiveness existed under those plans, but now we're phasing into new plans, and now we're gonna have a 30-year long-term loan forgiveness. So it's my understanding that the new income-driven repayment plan will still have this, but it's a lot longer than what we've seen with the current plans. So that's no panacea. Like if you've been paying 30 years on your loans and you still have a balance in an IDR plan, you're struggling a lot. And so you're still gonna get forgiveness under the new plan, at least that's my understanding. Okay, borrower's defense. If you went to a school that got closed, anybody remember like Corinthian Colleges or ITT Tech? You better remember those schools? And they just closed one day and stranded everybody. If you were in a situation like that, you can actually apply for, or sometimes it's automatically given to you to get your loans forgiven in those scenarios. But if you've ever been to a school that they kind of promised the moon and then they scammed you. It's a situation where you could potentially get loan forgiveness by applying for it. Bankruptcy and then disability and death. One thing I want to say about bankruptcy is that the bankruptcy code, and I'm not a lawyer, by the way, but the bankruptcy code has a specific line that exempts student loans, okay? So it's not as easy as like going to bankruptcy and saying, hey, I'm going to get my credit card debt forgiven and kind of wiped away. Of course, I'm not saying bankruptcy is a great option in any scenario, but student loans are exempt. And so there are specific things that you have to be able to show, like undue hardship, in order to get any student loans forgiven in bankruptcy, because it certainly is not a given, and it's actually an exception to the rule. So this is not a great option, although it can be for some people who are in really, really dire straits. But one thing that you should know with student loans, federal student loans, is that there's disability and death discharges. So I've worked with a lot of families that have like Parent Plus loans, and they're going into retirement, and they maybe have $200,000 they've taken out for their kids, and they're like, Jason, we're never going to pay this off. And I'm like, well, how long do you think you're going to live? Okay. And they're like, well, based on my life expectancy, I'm probably only got another 10 years. And I'm like, well, then it may be forgiven when you die. Like, and it's not a great situation to kind of talk through that, but just know that disability and death, there are discharges. The other thing that I would say too is if you've taken out Parent Plus loans, and I haven't looked at this guidance in a while, but I'm pretty sure this is correct. But look into discharge for Parent Plus loans, because I'm pretty sure if your kid dies that you took loans on behalf of, that actually that loan can be discharged at a Parent Plus level. So again, nothing we want to talk about, but if that's your scenario, it's good that you know that, because then you can apply for forgiveness. All right, any questions on that? Now we're to current events. So we'll talk about where we're at now.
We've got a question online.
Yeah, please.
They're wanting to find out about ways to work out or avoid wage garnishment.
That's a great question. And it's kind of a little too broad to answer in one fell swoop, because it depends on whether it's federal or private. And if it is federal, what I would say is work with your loan servicer to see what the, basically it's called, what's the term? Like rehabbing your loan, basically. But there's a specific process that you can go through to potentially get it back into good status. But outside of that, I wouldn't have a lot of good advice for that.
They say it's federal.
Yeah. So then working with your servicer to see what options there are to rehab the loan would be where you want to go with that. But it depends on how far along the line, because the Department of Education does take people to court and get garnishments and things like that. So it depends on how far kind of down it is and whether they've called the loan. By the way, there are student loan attorneys too, so that might be a situation that would be good to consult somebody like that. Okay, so current student loan events. You probably know, if you're sitting here, the SAVE plan was overturned by the 8th Circuit Court of Appeals. Oh, excuse me, that probably popped my mic. And so the SAVE plan is gone. Again, not gone because people are still in it, but it is gone in that it is a dead plan. Eventually, people that are in the SAVE plan are going to have to move somewhere else because that plan is being phased out based on a court case. So what do we have now? In terms of income-based repayment plans, as of today, not where we're going with one big beautiful bill, but as of today, we still have IBR, income-based repayment, we have pay-as-you-earn, and we have income contingent repayment, which of the three plans is probably the worst. The reason being because it takes a larger share of your income to pay for student loans. Really, ICR is an older plan and now is normally only used for kind of Parent Plus loan situations. And so it may be the only thing that you qualify for, and if that's the case, then it is what it is, but it's probably the worst of the three that are listed there. And things are changing quickly. So again, I had mentioned 10 minutes before I started this presentation, I looked back at the Department of Ed's website and they had changed some stuff on me. And so I had to update my screenshots. So it is changing day to day. They're adding new guidance, but this is essentially that new screenshot. We're going to talk through the things that are important. And by the way, I've always listed sources at the bottom. So I would encourage you, if any of these situations apply to you, please continue to look at this website maybe every couple of weeks to see if they've updated anything. And specifically what they had updated on this one was accruing interest. So the fourth bullet point was new since I've given this presentation a couple weeks ago for Mid-Continent. So it does change and you have to keep your eye on it. Okay, so the first thing is that loan consolidation and income-driven repayment plan applications are now available. The reason why they say that is because a few short weeks ago, they took the application offline. And so if you were in the save forbearance and you wanted to switch to another plan, you couldn't do it. There was no application. So those are back up, which is a good thing. Eligible borrowers can switch to a different plan now, so they can switch to the ones that still exist: IBR, ICR, or pay as you earn. Okay, so those are the only 3 income-driven repayment plans that exist anymore. Again, save plan people are in forbearance, but those are the only ones you can switch to because they're the only ones that still exist. Borrowers who enrolled in the save plan remain in forbearance unless they obtained a different status. So if you're in the save plan, you're put in forbearance because the court basically took that plan away. So instead of just like scattering you all to the wind, they just said, hey, let's take a breather. You're not going to have to make payments, but we're putting you in forbearance. Yeah, please. Forbearance means that you don't have to make payments. Okay, so they're basically saying you don't have to make payments during this time. The other thing, which is the next bullet, is that for the moment, there's been no interest accrual. But they're saying that borrowers in the save forbearance will now start accruing interest starting August 1st. So basically, forbearance is just kind of like a holding pattern, right? Because they don't know what to do with these people, so they've just put them to hold. They're like, this plan doesn't exist, so we're not making you make payments, but we're just waiting. So they're in this holding pattern, but now the holding pattern, you'll start to accrue interest again, which is a bullet that they've added just in the last couple of weeks. Now here's the kicker. So for those of you that are in the save forbearance and your plan is just to pay off your student loans and it's within your budget to eventually do so and you're liking the payment reprieve, but you're not going for public service loan forgiveness or anything else, heck, you may want to stay doing what you're doing, okay? Like you may just decide that I'm okay being in forbearance. Even if my interest starts accruing, I'm cool not making payments, okay? So maybe that's your situation, but if you are going for public service loan forgiveness and you need to make more 120 qualifying payments, you're not there yet. Well, save plan is a problem, right? Because unlike the COVID forbearance that we saw, none of your payments that you're not making are qualifying for PSLF, okay? So the question for you all is, what do I do now? And the department is essentially telling you right now that if you're enrolled in the SAVE plan and you want to start making qualifying payments, what do you have to do? You have to switch to a plan where you start making payments again. In other words, you have to switch to one of the existing plans, IBR, ICR, or pay as you earn. You have to move so that you can start making qualifying payments again. Yeah, please. Got it.
But I gotta go back and check, because I have several loans,
Mm-hmm.
different years, I went back to school and everything.
Yep.
But whenever I'm making payments on it,
Mhm.
on the PSLF, and it says I have like, 90 something qualifying payments for 120.
Yep.
But the weird thing is, it always says I have it due on the 6th of the month, but when I log in, it says 0 due.
Yep.
But, and so I'm not concerned going, well, are these, the money comes out of my bank account and I'm like, is it being? And am I getting credit for these payments? So I'm getting.
Yeah, it's a good question. And I couldn't give you an answer without looking at your specific loans and what your status is, et cetera. So I can't give you one answer. And for those of you that are online, the question is hey, I think I'm making payments, but my dashboard says 0 payments. And so am I getting credit when I'm making payments? I don't know. The answer is I don't know. I'd have to look. 0 payments makes me think that you're in the save forbearance. So I would either call your servicer or log into the dashboard, figure out what income-based repayment plan you're in, if any at all. If it is a save plan, then you're gonna have to take action. If you want to take action, right? You may decide, hey, I know eventually, like, because one big beautiful bill is going to push people into new plans eventually. So you may be in a situation where you're like, hey, I'm going to eventually get 10 years. Like, I'm okay with not making payments.
I'm making payments I've been making.
Yep.
My main concern is, every time I log in, it says, even though it says due date, like June 6th, for example, but
Yep.
when I log in, it says 0 due. And I'm like, no, because it has my loan balances.
Yep.
And then it says I'm on the PSLF, but then when I make a payment and then but if I call and they say, oh, well, he's on the save, the payments I've been making the past 2 years, are those gonna be qualifying then? That's my main concern.
Yeah, and that's the interesting thing. So if you're in the save plan and you're saying you're currently making payments, or you made payments like a few months ago?
I'm making payments like the past, well, I had the forbearance during COVID, like a lot of people.
Yeah.
did. No, I'm still working for government.
Yep.
But then after they sent, I can't remember the exact year, but when they said, oh, you have to start making payments again, I started making payments every month, never missed a payment. But then it just concerns me every time I log in.
Yeah.
I paid last month, and then it's just like still says zero due.
Yeah.
And I'm like, this makes no sense.
Yeah, that is interesting. Okay, so I mean, it makes me think that you're not in save if you're still making payments. That is my guess, but yeah, it's interesting. I don't know because there's a few kind of conflicting things there. So that's what I would look into. If you're in save, you're not making qualifying payments, but you also shouldn't be forced to make payments and save because you should be in a forbearance. Now there is a chance if that, and it does actually say it here. Borrowers who are enrolled or applied to save plan remain in forbearance unless they attained a different status. So there's maybe a chance that you attained a different status somehow and you're in save, but that would be probably the exception to the rule. So you just need to figure out what income-based repayment plan you're in, because yeah, if you're in one of the others, you're probably still cooking with gas. Yep.
So I still had to send in proof that I was a merit order from supervisors.
Yep.
Sent that in, my login, it shows that.
Yep.
And then I've been with government for almost 7 years.
Yep.
Government job I have now, federal government, and I've had to, every year I've had to send in proof that I'm still with the government.
Yep.
And they loaded up, it's there, so that's why I'm like, okay.
Yeah, correct. Yeah, and that was the other thing I was going to say. It sounds like you're doing it is that one way, because PSLF eventually, I think they would like it to be more kind of real-time reporting. The challenge with that is think of it from the government's perspective. They don't know when you change jobs, and they have like probably 1 million people in PSLF or whatever it is. And so they can't real-time report because they don't know, like, have you dropped from full-time to part-time? Or are you with a different employer? And so the only way that the Department of Education knows, or your servicer knows to update that PSLF count is when you recertify your PSLF. And so I used to tell a lot of my clients when I was consulting, hey, do your PSLF paperwork every year so that they can continue to update that number so you have a good understanding of where you are. Because I get a lot of people that are like, hey, I've been doing this for 6 years, but they've never filled out PSLF paperwork. And I'm like, you really have no idea where you're at. You need to fill out PSLF so you get an updated count as to where you are. Similar to like someone had mentioned earlier, this may not be applicable to them, but they're like, hey, I'm 3 payments away. Well, if that's not actually what it says on your dashboard, I would encourage, just fill out PSLF paperwork again, get it updated so you know where you're at. And by the way, some people are like, hey, how do I actually apply for PSLF when I get 120? Well, it's the same paperwork, right? You fill out that paperwork again, you raise your hand, you say, I've made 120, and then they look at all your history, and then they say, oh yeah, you've made it, you're done, and then you essentially get it forgiven at that point. Okay, all right, so where are we at? So PSLF. And then it says, if you submit an IDR application or recertification request and it hasn't been processed due to the court injunction, see below for next steps. So if that is your situation, please look at the source, and it gives some additional detail, but I think that's probably a rare occurrence, and so I didn't include that detail here. So the cool thing about this web page too is if you continue down, it has frequently asked questions about all kind of the main things. And I've picked the couple that are probably applicable to the folks that are at this workshop that are here. So the first is the Department of Education. It says ED. By the way, if you're wondering why it's not DOE, that's the Department of Energy. So Department of Ed always says ED instead of DOE. Is the Department of Education processing IDR forgiveness? And so you remember when we talked about long-term loan forgiveness under a plan? Well, this is kind of, I guess, not terribly applicable anymore because we're going to be put into a one big bill plan that has a longer long-term loan forgiveness window, and where it's kind of yet to be seen as to what credit you're going to get as you move over. My guess is you'll get all the credit, but who knows? So basically it's saying the forgiveness feature of save, pay as you earn, and ICR is currently paused. In other words, if you're in those plans and you're close to long-term loan forgiveness, it's currently paused. You won't get it. The Department of Education is not processing it. It does say that they'll still process loan forgiveness if you're an IBR, which is, again, a specific income-driven repayment plan. And the reason is because it's written in statute that it has long-term loan forgiveness. So again, the reason why I say this is if you're an IBR and you're wondering, you've made close to 20 years in payments and you're like, this should be forgiven, that's the only income-based repayment plan that they're processing long-term loan forgiveness for. So just keep that in mind. If you're in the other plans, they've paused it. And again, what about PSLF credit? This is kind of the main question for many people who are in save forbearance. What does that look like now? How do I get it? Well, we've already talked about door number one. There's really kind of two doors for you to pass through, and depending on your situation, and both of them have been mentioned already today. So the first is enroll in an eligible PSLF. In other words, you fill out paperwork to switch from the SAVE plan proactively to put yourself in one of those 3 income-based repayment plans that still exist. And again, if you're wondering, hey, which one's good for me, check out the loan simulator we talked about earlier today. The second thing that you may be able to do, and somebody had mentioned it in the comments, is what we call the buyback program. So what is the buyback program? Well, let's say you are, and I think this is the scenario that the person commented about, you are 117 payments towards 120. In other words, you have 3 payments left and you should be eligible for public service loan forgiveness. Well, you're sitting in the SAVE plan, oops, like you're in forbearance. You can't make eligible payments. So what are your 2 options? Well, one option is that you could switch to an eligible repayment plan and you could start making eligible repayments again. But another option is that the buyback program actually allows you to fill out an application, send it to the Department of Education. They look at your situation, and if they see any times of ineligible payments, basically for forbearance, they will give you a number and say you can buy back those payments from your forbearance. So basically you cut a check to the Department of Education for those 3 payments, that pushes you to 120, and you get forgiveness at that time. But it's not really for somebody just to say, hey, I'm at 60 and I just want to like bulk pay 60 payments and get to 120. Everybody with me here? Like basically this is for forbearance times like the SAVE plan where you've been in forbearance and you should have been able to make those payments, but you weren't able to. So now it's basically saying, hey, we'll let you buy back 3 of those payments to get you to 120. The challenge with buyback right now is I filled out for a client a buyback application and I got notified an answer in about a month. Okay, so it's pretty quick turnaround. I just did this workshop maybe three weeks ago, and someone had done the buyback application and hadn't heard back in 5 months. And they were working with their congressman to get a reply. Okay, so that's kind of what it is. The scenario where if you are eligible for buyback and it's a scenario where it might be helpful for you, then I would apply for buyback. But if you could maybe get those 3 additional payments by switching plans and making those 3 payments really quick, I would maybe consider that door as well, given that you may not get a quick response from the buyback folks, given everything that's gone on. So I know that's not a great answer, but I'm also not at the Department of Education, so I don't have to take that weight on my shoulders, but it just is the scenario that you're looking at. So what are your options? How are you going to kind of hedge your bets as to what decision you make here? Okay. So that's really what I have for today. I did want to just mention something else. So we kind of mentioned the one big beautiful bill, and how it was recently signed into law. Some other things that I'm reading about the bill are, there are some changes in the limits. We've already talked a bit about that. Parent Plus loan limits, there's going to be an annual limit and a lifetime limit. Also limits on graduate loan holders. And so I think someone had mentioned in the chat that they were looking at graduate school. Well, now Grad Plus loans, from what I'm reading, again, this may not be exactly correct as things roll out, but it looks like that there are new limits about 20 to 21,000 annually for graduate students with a cap of 100,000. So if you're going to go off to law school and law school costs 200,000, like you're not going to have the scenario to borrow another 100,000 for law school anymore, whereas you could have under current rules. So basically this new Republican administration with this new law passage, which it was probably a little bit bipartisan, but primarily Republican, that there's going to be some changes in what you can actually take out. There's also some changes in loan forgiveness and death and disability. PSLF, it looks like it remains Borrower's defense, there's some changes. So there are some additional changes with the new bill. But again, I wanted to focus on what's currently happening at this point. So I've listed your loan servicers here. I'm going to admit one person here. Here's your loan servicers. By the way, if you are in PSLF, you are assigned to a specific loan servicer that works on PSLF. So if you fill out paperwork, you'll be assigned to Mohila. It used to be another servicer before them, but there is one servicer that works with PSLF. So if you have been moved to them after paperwork, filling out PSLF paperwork, that is why. Everything that you need to know about student loans, federal student loans, studentaid.gov. It is the only authoritative resource. It is the Department of Education. The screenshots that I've pulled from here are from studentaid.gov. So make sure you're checking out that website. I haven't looked to see if they have updated changes based on One Big Beautiful Bill yet, but they will inevitably, over the next week, if they haven't done it already, or the next couple weeks, put a website talking about all the changes that will happen with One Big Beautiful Bill and how they will implement it over time. So again, that change where it says right now we should have a change by summer of 2028, it may get delayed. We've seen that happen with FAFSA changes. And so keep an eye on this if any of those One Big Beautiful Bill things are going to affect you as you go forward. The other thing that I would say is sometimes there's a difference between what's said on studentaid.gov and what's actually happening at kind of the servicer and processing level. And so one way that I keep up with that is through Reddit. If you go to student loans page on Reddit, or there is a specific PSLF page on Reddit, you can actually hear real people talking about things like the buyback program. You can search buyback. You can see people talking about their applications, how long it's taking them to get processed, what the hiccups that they're experiencing are, et cetera. And so I like to keep my eye on Reddit as well, just so that I can kind of keep my ear to the ground as to what's actually going on from real people. And then finally, here's my contact information. So if you want to reach out, feel free to do so, jason.anderson@ku.edu. I'm happy to field your inquiry. Again, sometimes I'm not able to give specific advice since I don't have a business doing this anymore, but I can try to help in the ways that I can or point you to the right resource so that you can help yourself. The final thing that I would say before I take questions here is a lot of people just feel overwhelmed after listening to all this, okay? And I wish it wasn't the case. But this stuff is complex and it changes a lot, and court injunctions are not helping. Gutting staff at Department of Education is not helping. And so there's not a real great answer that I have for you. The only thing that I would say is you gotta kind of keep up with this guidance as it comes out. And I know that's not a great thing for kind of an average layman with a student loan, but it's just a reality of the situation as we see it today. So my hope is that One Big Beautiful Bill actually will simplify stuff a lot. The problem is that we're probably not going to see some of that for the next 2 or 3 years as they implement it. So that's kind of where I would end it. I'm glad that we're making meaningful changes, but we're not going to see that for a little while. So, okay, I'll take questions. Thanks.
We've got a couple online
Yeah,
here.
please.
Hang on. If I apply for the 5-year teacher forgiveness, none of these payments can count towards PSLF. But after I get the teacher forgiveness, I can start counting payments towards PSLF.
Yeah, so it's a great question. And the honest answer is I don't know the current guidance on it. I would check the teacher loan forgiveness page on studentaid.gov. And I would check the public service loan page as well. My guess is it's in the frequently asked questions as to where it's at now. And I know that's not a great answer, but the reason why I say that is because there was a time with one of the PSLF programs, I forget if it was the waiver, I think it was the waiver around COVID, that actually they allowed those two programs to coexist and not be mutually exclusive. So the mutual exclusive is kind of status quo, normal PSLF era, but we've seen times when actually you could get credit for both, but I don't know where it's at now. I don't know whether it's separate or whether it's different. I just haven't seen the updated guidance. So I would check those 2 web pages and you should be able to find your answer. And if you can't find it, email me at ku.edu and I'll try to see if I can find it.
Someone asked about getting a copy of the PowerPoint. I can email that
Yeah,
out
that's
to
fine.
registrants.
Yep.
And we did record this evening's session, so once the recording is available on our YouTube channel, I will email that link out to all the registrants, whether you were here at Lee Summit or online. Someone else says they logged in to double check. I have the PSLF, but I have Ed Financial. I had Mohila until I was switched over sometime within the last year.
Yeah, interesting. So Mohila, and actually, so before Mohila, there was even another servicer that dealt with PSLF. But specifically, a lot of the PSLF servicing component, and I say servicing kind of loosely, but Department of Education has started to take a more active role in tracking PSLF. And so they took a little bit of that away of that from the servicer and started to house some of that in studentaid.gov and your dashboard that's housed on that website. And so it's interesting you say that because it was the case that when you applied for PSLF, you were always basically routed to the servicer that has PSLF as their charge. But you're the first that I've heard that said they're not being housed under Mohila, but that potentially makes sense given that the Department of Education, especially since you're saying the last year, has started to take some of that over. So they've maybe stopped automatically sending people directly to Mohila. That's what it sounds like. But yeah, that would be my guess as to what's going on there. Okay, any questions here face to face? Yeah, please, in the back. Yeah, yep.
What would, I guess I'm not understanding, so if you have a 5-year deal.
Yep.
Teach a low income area,
Yep.
and at the end of that 5 years, your student debt would be forgiven.
Yep.
What would be the benefit of then turning around and doing a PSLF? Would it be to reduce the amount of forgiveness?
Yeah, it's a good question. So the question is just some more distinction as to what's different between teacher loan forgiveness and public service loan forgiveness. Well, there's a couple things. So one is that low income environment. So if you're not in a low income environment, then teacher loan forgiveness is not going to be a good fit. So that's one of the main differences. That would be either or, which one am I going to pick? But the second one is teacher loan forgiveness is capped. Like it's not unlimited. And so I think the cap, if I'm remembering correctly, is like $17,500. So if you have more than that, then you're going to have a balance after you get teacher loan forgiveness. Then you'd maybe have to think about doing another program like PSLF. That's maybe also why, let's say you had an insane amount of, like you got your master's and your doctorate in teaching, all of a sudden you have $500,000. Well, then you may opt, if again, in kind of a normal PSLF world where they're mutually exclusive programs, you may say, heck with teacher loan forgiveness, I'm going straight for PSLF for 10 years because I want all of it forgiven, right? And so those are kind of the calculations that you have to make when you're thinking about one or the other program. And then again, that's why I was saying not a great answer that I don't know, but that's the truth because we've seen it be mutually exclusive where you can't count for both. And then we've also seen it where it kind of temporarily came together, and then probably it is mutually exclusive again, is my guess, but I haven't seen the most recent guidance. Yeah, great questions.
The person online did say that they're also in save forbearance, if that makes a difference.
Not particular. I don't think so. Not beyond what we've already talked about, but I'm not sure which question was that attached to.
The one where they had Bohila and they were switched to Ed.
Oh, yeah. Maybe, I don't know. And there may just be the flat out that with all the court cases and things like that, they may just got assigned to whoever had bandwidth. I don't know. But typically if you're in PSLF, you're attached to the servicer that has historically done it, which would be Mohila. But again, there's been some changes into how PSLF is processed. And so, yeah, it may just be due to that as well. I'm not sure.
Someone else says that it's only 5,000 for normal teachers, but special ed and math teachers can have up to 17,500.
Yeah, there you go. Yep. Yeah, thank you.
And then someone asks if there is a PSLF group on Facebook run by experts. And it's where I learned everything. It is so informative and I would suggest people join.
Yeah, okay. It'd be great to know the name of it if you have that. We could share that here face to face. If you want to put that in the chat. But that I've also found that to be very helpful in the PSLF for Reddit. Lots of great advice and kind of personal experiences to people that are actually filling it out. Because again, the challenge with student loans is you may see something posted on studentaid.gov, but you don't know how it's actually processed in real life. And so that disconnect can be really confusing sometimes. And so Reddit has been really helpful even when I was consulting to look and say, oh yeah, here's 5 people that have done it and it actually worked for them. Or here's a screenshot of someone who actually got forgiveness. So it can be a really good place to look as well. Well, great. Thank you all. I appreciate your time. And if you have any questions, shoot me an email.
Yep. And the name of that Facebook group is Public Student Loan Forgiveness Program Support.
Okay, great.
All right. Well, thank you, Jason, and thank you, everybody, for coming. If you can take a moment to fill out your survey and leave it for us if you're here in the room. I will drop that link into chat again for the folks that are online.